Good morning, ladies and gentlemen. Welcome to the G20 Global Financial Stability Conference 2021. My name's Sori Moon. It is an honor to grab the microphone as your master of ceremony at this meaningful occasion because I have worked for the Economy TV channel as the TV host for over 5 years. Well, before we begin, we'd like to extend our sincere gratitude for joining us today at this hybrid conference. Yes, today's conference will be run in the hybrid format due to the COVID-19. Well, this is inform you that the conference Seoul is being safely held as it has completed quarantine in accordance with the Korean government's quarantine guidelines, and all of our staff have completed the PCR test. Today's conference is being streamed live through the KDI YouTube channel and is operating both a Korean and an English channel. And I would like to sincerely thank once again all the experts and scholars around the globe for joining us today despite the time difference. This year's conference will be divided into 3 sessions. So please allow me to introduce briefly the titles of each session. The global financial stability risks and policy coordination in the pandemic era, the digital currency and their microfinancial implications, post-pandemic international financial market and system. Each session features presentations from designated speakers followed by the discussion and Q&A time. And during the session, we'll link the Q&A address at the bottom of the YouTube screen for our online viewers participating throughout the YouTube live streaming. And I believe the conference will be livelier if everyone leaves their opinion and questions during the session. So I look forward to your active participation. Then now, ladies and gentlemen, we'll start the G20 Global Financial Stability Conference 2021. Co-hosted by the Korean Ministry of Economy and Finance and KDI. Now let us begin the opening ceremony with the opening remarks from the first Vice Minister, His Excellency Eog-weon Lee of the Ministry of Economy and Finance, Republic of Korea. Please welcome him with a big round of applause to the podium.
Distinguished speakers, guests, ladies and gentlemen, good morning. This is First Vice Minister Eog-weon of the Ministry of Economy and Finance of the Republic of Korea. Welcome to G20 Global Financial Stability Conference 2021, co-hosted by the Korean Ministry of Economy and Finance and the Korea Development Institute. I would like to extend my deepest gratitude to KDI President Jang Pyo, whom I had the pleasure of jointly organizing this conference with, and Professor Jeffrey Frankel, who will deliver the keynote speech on the recovery of the global economy's imbalance post-COVID, and all presenters and panelists who will be sharing their invaluable expertise today. The G20 Global Financial Stability Conference, which is being held for the 7th time this year, aims to establish a flexible and stable international financial system and contribute to a solid growth of the world economy. This occasion is being held as a hybrid conference where some participants are joining in person while others are joining virtually. We hope this unique gathering may serve as an opportunity to heal the wounds or scars from COVID-19 and augment the resiliency of the global economy as well as the international financial system. Recently, we are seeing that the global economy is showing signs of recovery thanks to the supply of vaccines and proactive response policies of various governments. Nevertheless, there are elements of concern. We are seeing uneven recovery among countries as well as within countries. We are witnessing the outbreak and spread of variant viruses such as the Delta variant, and we are also facing the possibility of inflation due to the rise in prices of raw materials coupled with supply chain setbacks. And if we look at the monetary policies, we are seeing a transition, although some of the concerns are alleviated with the with the Jackson meeting in the August meeting. However, we can say that there are still liquidity and that leading to household debt. So in other words, the accommodative macroeconomic policy trend has been leading to household and corporate debt, as well as risk-taking trends may be on the rise. And with such factors of instability, it is too early to take a collective sigh of relief. Moreover, we are confronted with substantial challenges such as worsening climate change, likelihood of pandemics, transition to digital economy, and polarization between classes and divisions. And therefore, these critical issues require preemptive action. Ladies and gentlemen, G20, which was elevated to a summit meeting after the 2008 global financial crisis, has been serving a pivotal role in the European financial crisis management and now the COVID-19 crisis management. We expect that G20 will play a leading role in seeking a sustainable growth for the world economy and stability of the international financial market. And in order for that to be realized, we need to consider the following three elements. First, for the speedy recovery of the global economy, G20 needs to become a communication channel to enable different countries to reach agreement on swift vaccine supply and orderly exit from the current policy stance and other such critical issues. Second, G20 needs to remain true to its role of the highest level multilateral cooperation system that strives for global financial stability. To this end, G20 needs to come up with a plan to rechannel the recently established $650 billion of IMF SDR to minimize negative ripple effects from monetary policy transitions of major countries while seeking ways to ease the debt burden of low-income countries. Lastly, G20 needs to take the initiative in examining and responding to emerging post-COVID-19 challenges in order to serve as a comprehensive cooperation platform. G20 is currently actively discussing key issues such as the rapid mitigation of climate change and carbon pricing, upgrading the global cooperation system for pandemic response capacity building, introduction of the digital tax, the impact of the central bank digital currency, and alleviating polarization between classes and divisions. Through this process, I hope G20 will work closely with the IMF, World Bank, OECD, BIS, and other international organizations and civilian experts to generate meaningful results in coming days. This Global Financial Stability Conference today is part of our effort to examine the impact of world's economic risk factors on the international financial system, to analyze the impact of digital currencies and stablecoin, and come up with a response plan, and to establish a better and more sustainable international financial system in our ever-changing environment. During this conference, I am sure diverse insights and plans will be shared for a rapid recovery of the global economy and improving the stability of the international financial system. I also sincerely hope that those insights and plans can be concretized to become actual policy alternatives. Finally, I wish to express my genuine appreciation to everyone who has worked tirelessly to prepare for this conference. Thank you very much for your attention.
Thank you. I'd like to thank the Vice Minister for arranging a meeting to discuss what policies are needed for the global financial stability. Thank you very much, Mr. Vice Minister, once again. And next, we'll have the opening address from the President of KDI, Jang Pyo. Please welcome him with a warm round of applause to the stage.
안녕하십니까.
Distinguished guests, ladies and gentlemen, good morning. This is President Jang Pyo of KDI. First and foremost, I wish to express my most sincere gratitude to everyone joining our conference today, both virtually and in person. Especially, I would like to extend my special thanks to Deputy Minister Eog-weon Lee of the Ministry of Economy and Finance of Korea, who has made invaluable contributions to organizing this important conference. I wish to also express my most heartfelt appreciation to Professor Jeffrey Frankel for his keynote speech, as well as all moderators, presenters, and panelists for sharing their knowledge and expertise. As all of you are painfully aware, the COVID-19 pandemic has resulted in the worst worldwide economic recession since the Great Depression. This year, however, vaccines were developed and made widely available across the global community to make meaningful headway on many fronts, including economic recovery. Reflecting this positive trend, the IMF has forecasted in July that the world economy will grow by 6% this year, which far surpasses the negative growth in 2020. However, countries are recovering at different speeds because of substantial disparities in their response capabilities to the virus, as well as economic policies and capacities. On the one hand, we have advanced countries that are picking up speed in their economic recovery thanks to financial and monetary easing in tandem with a swift vaccine supply. On the other hand, we have emerging economies and developing economies relatively slow in maintaining momentum in the rebound. I want to draw your attention to this gap that we are witnessing between advanced and emerging economies in their economic recovery may act as a major hindrance to overall global economic growth. As many of you recall, after the 2008 financial crisis, the economic policy normalization process of advanced countries had led to capital outflows, which contracted financial conditions in emerging economies, ultimately giving rise to a taper tantrum among economically vulnerable countries. At the same time, the COVID-19 pandemic has proven to be a major accelerator of the digital transformation, spurring decisive structural changes. Internet banks having no actual offline branch offices, online platform-based food delivery industry, and online legal and accounting services are just a few examples of how businesses have morphed to become closer and more essential to all of us in our day-to-day life during the pandemic. With the rise in demand for contact-free services, digitization becomes more rapid, paving the way for leapfrogging technologies to further expedite digitization. This pivotal transition to digital economy is felt both in our daily lives and in the international financial system. Digital currencies such as central bank digital currency or CBDC and global stablecoin are triggering debates and discussions in both public and private domains, challenging policymakers to re-establish the balance between financial stability and efficiency. Distinguished guests, ladies and gentlemen, looking back to the 2008 global financial crisis, we should remember that the G20 summit rallied for a immediate collaborative effort to bring significant contributions to crisis management at the time. Roughly a decade later, we're dealing with an economic crisis prompted by COVID-19. Despite difficulties, the G20 summit must once again aspire to meaningfully contribute to a more balanced recovery for the global economy and seek a mechanism for international cooperation. I look forward to in-depth discussions of great insights during this conference on an inclusive and balanced global economic recovery and strengthened global financial stability. I believe we can achieve this goal through building confidence and trust in one another. Once again, I'd like to thank all of you for joining us despite all the time difference and distance between us. With that, I would like to conclude my welcome speech. Thank you very much.
Thank you very much, the President Hong, for reminding us the meaning of today's conference again and giving us warm-hearted speech. Thank you very much once again. And now, ladies and gentlemen, it is my great pleasure to introduce our keynote speaker, the Professor Jeffrey Frankel from Harvard University. The Professor Jeffrey Frankel will be presenting about Might the Pandemic Signal the End of Global Economic Convergence for Us. So he's now connected live online. How are you, Mr. Professor?
I'm very good.
Thank you very much. We are all ready to hear your keynote speech.
Okay. Hello, everyone. I'm Jeffrey Frankel. I have the title of Harpel Professor of Capital Formation and Growth at Harvard Kennedy School, which is at Harvard University. I'll share my slides in a moment. I want to say it is an honor to be delivering the keynote address before such a distinguished program. I would like to thank the Korean Ministry of Economy and Finance and KDI, the Korean Development Institute, for inviting me. Let me just share the screen. Okay, I assume that people can see that. If not, please let me know. Just to give you an overview of what I'm going to talk about, I'll start with a word on the global outlook. Then I'll introduce the theme of economic convergence across countries. And note that growth in emerging markets and developing economies slowed down after 2013, even before the pandemic. And I'll discuss some possible factors why that might have been. That's looking backward. Looking forward, I'm going to identify three possible dangers that lie ahead. One of them is concerning financial stability, which is the main focus of this conference. And then that corresponds to three broad policy areas that I think deserve attention by the G20. Summary of the global economic outlook, stylistically. The world economy did better than expected in the first half of 2021, better than expected as of January, for example. And I think we know the reasons for that. Monetary and fiscal stimulus, massive monetary and fiscal stimulus in the case of US and some advanced countries, but monetary and fiscal stimulus in most parts of the world, together with what I would call a scientific miracle, the development of the vaccines to address the coronavirus. Looking forward, downsides are evident. First, the everything bubble might burst. If you're not familiar with the phrase everything bubble, this is the notion that asset prices, particularly prices of risky assets, have gone up above the level justified by fundamentals, and that it shows up in stocks and bonds and maybe commodities and all kinds of assets. And the second downside is that vaccination rates have been slower worldwide than they need to be, than they need have been, than they should have been. The divergence comes from the fact that the downside is worse. The implications of a bursting of the bubble could be a debt crisis among emerging market and developing economies. And in case of vaccination, developing economies don't have access to the vaccine to the extent that the advanced countries do. So that's the global outlook. What do I mean by convergence? The red bars are the economic growth rate of the emerging market and developing economies. The blue bars are the growth rates. This is in GDP per capita now. The blue bars are the growth rate of advanced economies. And you can see that from the turn of the century up until 2013, the emerging market economies were growing substantially faster. There's about a 4 percentage point difference between the red bars and the blue bars. The green line, or the black line that's marked by a green arrow, corresponds to the right-hand scale. This is the level of GDP per capita in the emerging market and developing economies relative to the US. And it rose strongly, rose throughout this period, but particularly strongly up until 2013, from something like 12% up until, well, eventually reaching developing economies reaching 20% of GDP per capita of the advanced economies. Part of the good performance, good relative performance, is that the emerging markets survived the global financial crisis relatively well. While advanced economies went into a steep negative growth, the emerging market economies continued to grow at a diminished rate, but at least they continued to grow. And I'll give some reasons why I think the emerging market economies survived the global financial crisis relatively well. After 2013, there still was some convergence, but much slower. You can see that the red arrow is much shallower, much flatter, and this is beginning even before 2020 when we had the pandemic. In 2020, the convergence slowed down even more. And this graph mixes together the middle income countries and the low income countries. If I showed you a version of the graph that just does low income countries, in that one, the red arrow actually turns down. We actually had a reversal of convergence in 2020. Here are growth projections from the latest World Economic Outlook from the IMF, and they've revised upward their estimates of growth in advanced economies. So the U.S. is projected this year to grow at 7.0%, and they equally revised downward their projections of emerging markets and developing economies. And you can see the lower income countries at 3.9%. So that's unusual to have, or at least unusual in the 21st century, to have the low income countries growing substantially less rapidly than the high income countries. What are some reasons for this slowdown? I'm not going to give you a comprehensive list, but some possible explanations. Convergence is brought about in part by global trade, and global trade slowed down during this period, during the second decade of this century. Second, commodity prices fell on world markets starting in 2014, particularly commodity prices expressed in dollars, which is certainly relevant if you're a country that has got dollar-denominated debts. Third, China is a big part of the story for why global trade had been increasing so rapidly and why commodity prices had risen. And China slowed down after 2010, probably inevitably, perhaps after 3 decades of double-digit growth, of 10% growth, perhaps due to diminishing returns to capital or the Lewis turning point in rural-urban migration. And finally, I'd like to pose the possibility that emerging markets have become more vulnerable over the last decade to sudden stops in portfolio inflows, more vulnerable than they were in the global financial crisis of 2008, 2009. Why do I say this? Well, after the turn of the century, emerging market countries made some reforms which made them less vulnerable to sudden stops of portfolio inflows. Fiscal policy became less pro-cyclical. Capital inflows were used to build reserves rather than to run current account deficits. And the dollar-denominated share of inflows was reduced, especially in the case of public debt. So these were many emerging market countries learned the lessons of the international debt crisis of the 80s and the East Asia crisis of the 90s, where they hadn't gotten these things right and improved their policies after the turn of the century. However, after 2010, some backsliding occurred, whereas countries had mostly taken advantage of the boom of 2003 to 2007 to strengthen their budget, giving them some fiscal space in 2008, 2009. That didn't happen with the boom of 2011, 12, 13. More budget deficits, more current account deficits, and a return of dollar-denominated debt, not so much in the case of public debt, but corporate debt, which is a vulnerability that's out there now. Dangers looking forward. And I'm going to talk a bit about the longer term, but I'm leaving aside the truly long-term dangers of climate change, which are maybe not so long-term. They're arriving faster than was expected. They're going to hit middle latitude countries especially hard because they're already hotter. And this will and should attract a lot of attention and focus from the G20. Number one, the pandemic could halt catch-up in developing countries' incomes. Number two, emerging market debt crises could return, especially when the Fed signals an increase in interest rates. That's what happened in '82. The Fed tightening didn't cause, but precipitated the international debt crisis. '94, the Mexican peso crisis. '97, East Asia crisis. 2013, the temper tantrum. 2015, 2018, and so on. Third, the world could lose out in the race between vaccination and new variants. We could have a new variant that is even worse than the Delta variant, and that is more powerful than the vaccines. So I think we can characterize that as a race between these two factors. In the US, we have a lot of vaccine skepticism. We have some of it in other countries, but in lower income countries, a major problem is lack of availability of the vaccines. Well, the role of the G20 is international cooperation is more important than it's ever been. And I think the pandemic has illustrated that. Now, by cooperation, I'm not necessarily referring here to coordinated setting of national monetary or fiscal policies. There's a big academic literature on that kind of coordination of policies. I'm generally of the view that countries can move their monetary and fiscal policies in the right directions on their own, especially countries with floating exchange rates. I'll return to this point in a few minutes. What I want to talk about is as three areas of focus for the G20. Not an exhaustive list by any means, but three things I want to talk about are first, initiatives to enhance financial stability, to reduce the likelihood and severity of new financial crises. Already we had last year the debt service suspension initiative, and we had just the last month the new SDR allocation by the IMF. I think these were steps in the right direction, but they're relatively small steps, and much more needs to be done. And I hope in some of the sessions in the conference that some of these initiatives are discussed. Much more is needed. Second, I'll argue that it may be time for some good old-fashioned trade liberalization. And third, we need to enable vaccination worldwide. Let me say a bit about financial stability. When the COVID-19 shock hit, or the coronavirus hit in March 2020, there was a shift to risk off, from risk on to risk off. Investors pulled briefly out of stocks and bonds and junk bonds, and they pulled out of emerging market assets. So you can see the sharp rise in emerging market interest rate spreads, especially for the frontier countries, but also for other countries. Of course, that didn't last too long. The Federal Reserve Board and other central banks eased aggressively in the latter part of March. And for that reason, I would say, the asset prices recovered, the spreads came back down to the point where the sovereign spreads are almost as low now, have been almost as low as they were before March of 2020. That's the prices of the assets, or the interest rates. So here's the quantities. We had capital inflows into emerging markets in January 2020. This turned sharply to outflows in March of 2020, but then bounced back pretty strongly thereafter. And this has allowed emerging market countries to finance current account deficits and budget deficits, which is appropriate at a time of crisis like the pandemic has posed. The problem, of course, is that debt has been accumulating. It's been accumulating particularly rapidly in 2020, in advanced economies, but the US can get away with a lot that emerging markets can't. So the concern is that the ratio of debt to GDP on the right graph for emerging market economies has been rising since 2013, but rose particularly sharply last year. Well, emerging market debt sustainability is vulnerable to a future rise in interest rates. As I mentioned, governments were able to finance spending in response to the pandemic, and I think that's a good thing. But I worry about the high debt to GDP ratios. Now, I have colleagues who say, don't worry about the debt to GDP ratio. Interest rates are so low that even though debt is high in so many countries, the interest rates are so low that the interest rate bill as a percentage of GDP or as a percentage of tax revenue hasn't risen, has even gone down somewhat. So why do I worry if the interest payments are low? Well, of course, it's because interest rates may go back up again. And I define debt sustainability the usual way, that debt is sustainable if the ratio of debt to GDP or debt to exports is expected to decline over time as you look forward. And it's unsustainable or explosive if it's expected to rise. Well, it wouldn't take much of a rise in interest rates in emerging market countries, whether originating in a rise in US interest rates or the local spread, the local risk premium, or some combination of the two. It wouldn't take much of a rise in interest rates to put countries on the unstable side, the unsustainable side of the debt sustainability analysis line. Now, you might say, if I'm identifying an increase in interest rates as the cause, as a thing to worry about that might precipitate a new debt crisis, like the crises of the 80s and the 90s, why do I downplay monetary cooperation? Why aren't I taking the position that Raghu Rajan took in 2014 when he was governor of the Reserve Bank of India and was essentially complaining about well, the Fed hadn't started raising interest rates, but they started tapering quantitative easing, and the famous taper tantrum resulted in a rise in interest rates and investors pulling out of emerging market countries. And Rajan urged major central banks, particularly the Fed, to pay attention to these factors and to cooperate more and to communicate more. Let me explain why I not that I want to put down monetary cooperation, and certainly I'm in favor of monetary communication among central banks, and then the Fed needs to signal extensively where it's going as soon as it knows. But what complicates matters is that I think we've got this everything bubble, the bubble component in prices of risky assets. And this means the financial situation must be judged particularly fragile. Why do I say a bubble? There's some who say high asset prices, the high price earnings ratios in the US stock market, for example, are based on new technology and prospective productivity growth based on economic fundamentals. I could just barely maybe believe that about the US, about stock markets. But there are four phenomena that to me just are screaming that the financial sector in general is in a bubble, this everything bubble. One is meme stocks, like the famous GameStop bubble, I would say, and some others as well. This goes beyond anything that can be justified by fundamentals. Another is digital currencies, particularly cryptocurrencies. I personally, to be honest, didn't see the market justification for Bitcoin other than evading the legal authorities. But I certainly don't see the justification. Maybe I'm wrong about that. But what I can't believe is that there are over 6,000 cryptocurrencies now, or 11,000, depending on how you look at it. And that just can't be right. The third one is SPACs, special purpose acquisition corporations. And the fourth one is non-fungible tokens, which I really don't understand. Maybe I'm just out of it, but these are four independent, semi-independent phenomenon that are just screaming out that perhaps because of easy money, bubbles often start on the back of low interest rates, but that the prices are too high and are vulnerable. So the Fed has a difficult job of letting some air out of the bubble without precipitating a financial crash. And I think that this task is really the same for the Fed if they were looking at the domestic U.S. financial markets or at world financial markets. It's essentially the same task. It's great if they communicate with their colleagues in other countries, but I'm not sure that you would get a very different answer if you explicitly gave the Fed more responsibility than they have under their mandate for global financial markets. All right, area two I wanted to talk about was trade. The trade for several decades was increasing approximately twice as fast as GDP. This is globally. And so you had an upward trend, steady upward trend for some decades in the ratio of trade to GDP. Well, that stopped, and it stopped even before Trump's tariffs or before the pandemic. It stopped in 2008, and trade to GDP, if anything, has gone down since then. And I think this is, I mentioned that trade is one driving factor of convergence in the period in the first decade of the century. I want to put out 4 ideas for trade liberalization that I'm in favor of, even though if some of them are not entirely realistic. First, the U.S. and China raised their trade barriers over the last 4 years. I think they should roll them back, just good old-fashioned trade liberalization. Second, an area that's particularly appropriate to liberalize is trade in environmental goods, like turbines for wind power and solar panels for solar power. You would think that maybe given the externalities involved, that there would be favorable treatment for these imports. But surprisingly, both in the US and the European Union, there's a disproportionately high share of trade barriers against these products, against the equipment in renewable energy. I would like to see an agreement to reduce these barriers. 3, carbon border adjustment tax. I think we need to agree on international rules to guide it. The European Union is in the process of enacting one. Other countries, including the US, talks about it. I think that carbon border adjustment tax should be a part of global climate change regime. So it should be used. But there's a great danger it'll be misused, it'll be abused, that a country that is not doing all that much on limiting greenhouse gas emissions will put the carbon border adjustment tax against imports from countries that are doing more, that are abiding by the Paris Agreement commitments, for example. And I think we need rules. And the WTO is a place probably to work with to get a global regime in place for what is acceptable and what's not acceptable in carbon border adjustment taxes. Finally, this one I hope is realistic. I think it's very exciting that we finally made progress towards a global regime for corporate taxation, and this process needs to be completed. And there, the OECD has a special role. And finally, vaccination. Vaccination in lower and middle income countries lags far behind the rich. This is another kind of divergence. There is, this is single vaccines, but the high income countries have rapidly increased the share of the population that's vaccinated, while low-income countries, I think it's barely 2% have been vaccinated. So the U.S. and other rich countries should make vaccines more extensively available to lower-income countries. I mean, they're doing it already, but this should be just a massive, all-out effort, both to vaccinate everybody within the advanced countries and to vaccinate everybody within the other countries. It's frankly somewhat ridiculous to see us chasing after vaccine skeptics at home, trying to coax them into accepting the benefits of this scientific miracle, which is capable of defeating the pandemic, without at the same time doing more to bring vaccines to other countries where they're most needed. And there's a proposal by Agarwal and Gopinath of the IMF for a specific plan of action. They estimate that the cost would be $50 billion, and they estimate that the benefits would be $9 trillion, $9,000 billion. That's a benefit cost ratio of more than 100 to 1, almost 200 to 1. Well, I think I've used my time, so let me just conclude by saying, so long as this coronavirus runs wild anywhere, it is a danger to everyone, everywhere. That's international interdependence. That's the kind of job for the G20. Thank you.
Thank you. Thank you very much, Mr. Professor Jeffrey Frankel, for the inspirational speech. Thank you very much once again.